Big things sometimes come in small packages, and that was the talk on Wall Street today. Stocks finally broke their 5-day losing streak, but it wasn't the big, well-known companies that lifted the markets. It was small-cap stocks. They have quietly and steadily risen in value, and today, the Russell 2000 index of smaller companies closed at a fresh all-time high. So far this year, the Russell index has surged 27%. That's a lot more, 10% more than the gains on the Dow average this year. Also giving a boost to the markets today, good news about jobs. Initial jobless claims dipped to a nearly 6-year low. Looking at the closing numbers, the Dow added 55 points, the Nasdaq rose 26, and the S&P 500 index up almost 6 points.
So, Susie, with small company stocks up 27% so far this year, do they still have room to run? Here to answer that question and more is Jay Kaplan, portfolio manager and principal at the Royce Funds. Mr. Kaplan, welcome. So why are the small companies outpacing the big blue chips by so much, and can they continue to?
Well, you know, it's been a very good year, like you've talked about, and because interest rates have been zero and we've had economic growth in the U.S., albeit slow, but economic growth. With those two things together, that's been very good for stocks, been very good for small caps. If you go back to the spring, when the Fed started to talk about tapering, the implication there was that the economy would grow even faster, the U.S. economy in particular, and small cap stocks are very much leveraged to the U.S. economy. So the market took that as a signal to keep the small cap stocks going up, and they performed better than the rest since then.
All right, so to follow on that line of thinking, Jay, if the Fed is now saying that it's going to hold off on its tapering plans of the stimulus, that would mean that the economy is slowing down a bit, and so small cap stocks shouldn't perform as well. Why are they continuing to go up?
Well, as long as the economy is performing at greater than zero and it's a couple 3%, that's fine. And rates, like I said, still very low. That is also still fine. Now, that's not to say that we couldn't have a correction in here at any point in time. It's been a terrific year. So if the small cap stocks went down 5 or 10%, that would not surprise us at the Royce Funds. That's kind of a normal occurrence. But even with that kind of a dip, that would still make the small cap performance for this year an absolutely terrific year.
So if they're up 27, 28% so far this year, that would suggest that some small cap stocks have gone out of the undervalued territory and maybe are fully priced or maybe even a little more. Are you still finding values anywhere? And if so, where?
Well, we are finding values, and at Royce, what we're focused on now is the quality trade. We think you need to own high-quality small-cap companies, those companies that have very strong balance sheets and earn high returns on capital. And if you think about the Russell 2000 for a second, 30% of the stocks there don't earn any money whatsoever. Those have been the best performers, and the companies that earn a lot of money and have great returns, those have been the ones that have lagged.
Jay, give us some examples of some stocks, so if our viewers are interested in dipping into this area. Can you give us a few names?
Sure. I can give you a couple of names in the retailing space and specialty retailing. One company we like very much is The Buckle. The Buckle sells apparel to folks between kind of 18 and 30 years old. It's a focus on jeans. It's a focus on higher-end jeans so that they're not competing at the $29.99 killer price point throughout the mall. They're more of an $80, $90 jean product. Wonderful company, great management, has a great track record of paying dividends, and that's one we like quite a bit.
How about some others? And I take your point. I mean, you're basically saying, look at the balance sheet, look at the income statement, and stay away from those stocks, those 30% of stocks that have no earnings at all. You're pointing us to ones that actually are churning out money, right?
Right. We don't want to own the junk. Since rates have been zero, the junky companies that maybe would have died in past economic cycles were able to refinance their way back to life. They're kind of zombie companies, and those have gone up. I mean, another company we like, still kind of in that apparel area, really on your feet, is Shoe Carnival, a retailer of shoes. They have a lot of good growth. They cater to the family. There's been some management changes there. They've reinvigorated their store growth. They're adding more brands, and it's a really wonderful company. We like that one as well.
I assume these two companies you mentioned, The Buckle and Shoe Carnival, are ones that are in a Royce portfolio somewhere?
They are absolutely in Royce portfolios.
Do you own them personally?
I do not.
All right, Jay, thank you very much for your help tonight. We appreciate it.
You're welcome. Thank you.
Jay Kaplan's portfolio manager and principal at the Royce Funds.